You don't own a home without fire insurance. You don't own a car without collision insurance. And of course, health insurance is an absolute necessity. But while most of us own a stock portfolio that is incredibly important to our financial well-being, we often lack any sort of hedging or risk mitigation tool to protect us against a steep market crash. Not only does this leave us feeling anxious, it also forces us into poor emotional decisions, such as panic selling and market timing. Over time, the stock market has had a long-term upward trajectory. However, corrections and crashes are constant and can last some time. A bear market is defined as a decline of 20% or more. Since 1928, there have been 26 bear markets with an average drop of 35%. That's about one every 3.5 years. Some bear markets are short-lived, while others tend to drag on for years. Between 2000 and the end of 2009, investors experienced what became known as the lost decade. Investors in the S&P 500 experienced 2 market crashes during the lost decade, and the market was essentially flat for the entire 10-year period. As we look forward from here, investors are understandably nervous. As of 2020, Morgan Stanley reported that the American stock market today, relative to the rest of the world, is at a 100-year high, both in relative price terms and also in terms of the valuations. The Q ratio, a relative measure of valuations, has surpassed its highest level in history, and probabilities of a more severe market decline are higher. Virtually every valuation method now illustrates that the market is the most expensive it has ever been. Traditionalists might say that a portion of our portfolio in bonds, a 60-40 ratio, for example, will act as downside protection against a downturn. When the stocks do poorly, one hopes the bonds will do better and vice versa. However, many experts are suspicious of this assumption as we are in uncharted waters. Bonds are at record highs, junk bonds are more prevalent than ever, and interest rates are held at near zero or even negative in real terms. So, what is an investor to do? For decades, risk mitigation tools, also known as tail hedging, have been available. In general, one pays 2 to 3 percentage points of their total portfolio per year to buy the necessary stock options that, in the event of a market collapse, should pay off significantly. The goal is that the payout will essentially cancel out the losses sustained by the drop in stocks. The problem is, similar to insurance, if you don't use it, you lose it. It's a sunk cost that drags on performance. Maybe, more importantly, one can get tired of paying these costs during bull markets when it feels unnecessary. Case in point, in October of 2019, just a few months before the pandemic caused a massive sell-off, the CalPERS Public Employees Pension Plan decided to eliminate their risk mitigation program. They would have received more than a $1 billion payout, but instead took the full brunt of these losses. But what if there was a way to minimize or even offset these costs, but still retain the protection against a market crash? Let's explore. Imagine if an investor constructed a traditional portfolio of 60% stocks and 40% bonds. Instead of riding out the storm and hoping for the best, we would reallocate 10% of the portfolio to a holistic risk mitigation strategy. The risk mitigation portion of the portfolio would be designed to generate a safe and predictable return using uncorrelated strategies and use the returns generated to purchase the various hedges required for insurance protection. The outcome for such an investor is that this portion of the portfolio should typically break even or generate positive returns while awaiting an inevitable correction or bear market. When the market ultimately has a steep decline, the risk mitigation strategy should pay out and can essentially cancel out the losses in the stock portion of the portfolio. Typically, the faster and steeper the slide, the greater the payout should be. This loss cancellation approach allows investors to be more aggressive with their portfolio allocation while protecting on the downside. It also should create additional cash, which could be used to be a buyer when everyone else is a seller. Investors deserve the peace of mind that a market crash won't derail their financial plan, or better yet, a solution that creates potentially higher returns with lower risk. CAZ Investments has spent the last 20 years providing our investors with exclusive access to unique alternatives across a broad spectrum, from private equity to private capital to risk mitigation and more. Visit us at cazinvestments.com and schedule a call with a team member today.